Hello everyone, welcome to today's webinar on creating the ultimate GL using CRGroup Solutions for Dynamics to effectively rebuild your GP chart of accounts. It's a little bit about me. I think many of you know me. There are customers and partners on today's webinar. My name is John Smith. I am Director of Enterprise Business Solutions here at CRGroup. Have been working with the organization for the last decade and work extensively with Dynamics GP. So we're here today to talk about the GL structure. And, you know, through our years of experience, we have done a whole load of GL restructures, both with our customers and out with partners using our tool set that's available to help with this. And through those years, we've learned a lot. And we see need for changing GL structures come across in lots of different ways. And here's some of the more frequent ones we see. First, right away, to improve both financial and management reporting. One of the biggest requirements and one of the biggest reasons why we look at changing a GL structure is to help with financial reporting. Another one is consistency across multiple legal entities. Oftentimes businesses grow, they acquire other businesses, and we may end up in a situation where one company has a GL structure that doesn't mirror or match another company under the same umbrella. Another one would be consolidation issues. Again, if we have multiple companies, a similar GL structure is going to help with consolidation and certainly with intercompany transactions flowing between the companies. Assistance with budgeting and planning. You know, sometimes the sheer number of GL accounts in a structure make it difficult to effectively implement a budgeting solution. It may make it difficult to track actuals versus budget because we've got budget set on a certain set of accounts and actuals are coming in on a whole load of other ones, and we can't kind of compare the two to do any sort of meaningful variance analysis. So sometimes this comes right into the sheer number of them. Oftentimes in budgeting and planning solutions, the structure of the GL also creates an organizational structure in the budgeting and planning solution, and that's another reason why clients often look at the need to kind of restructure the accounts. Reducing the total number of GL accounts. That's a big one. Of course, we see that, especially since Mass Modify is a tool available in Dynamics GP. We sometimes think it's easier to grow that list of chart of accounts than to restructure. So we certainly see that one as well. Integration requirements. Yep, sometimes a new business system or a certain type of integration is required, and it requires a restructured GL. It might require a dedicated segment, and it might require just a new set of accounts. And of course, the organization structure's changed. And I think, you know, some of our clients go through an annual budgeting cycle, and they say to me, John, every time we go through a budgeting cycle, our org structure changes. So we think about that as well when we look at restructuring the general ledger. We have some principles that we try to follow whenever we get engaged or whenever we participate in a GL restructuring exercise. And these key principles help us determine what path to follow and ensure that we get the right structure in place. The first one is that we want to make sure we've got consistency of reported information across business units. I mean, making sure there's compatibility between all of them. We talk about the ease of consolidation, of course. We want to make sure that we have the ability to benchmark between different business units, areas, or entities within the organization structure. And so again, a consistent, reliable chart of account structure will help us achieve that. Reduce learning curve for new hires because, you know, one chart of account structure is the same across all of the entities. The same structure is in place. Reduce time spent on reconciliation issues. And of course, and really important, especially if you're going through this exercise, you already know the last point. You need to build in the flexibility to allow for growth in the structure without sacrificing the transaction efficiencies that are required today. So we think of those principles, and we really then zone into how do we do it, and what does it mean? And when we start looking at it, the biggest one, again, that comes out of this is usually a requirement to improve enterprise reporting and analytics. And yeah, there's a bullet point here that says single most important component of the chart of accounts design. And there's a reason why. And as all of you know who use Dynamics GP today, we always balance this reporting need between the general ledger and the information it provides and the sub-ledgers and the information they provide within the system. And so we do a bit of a balancing act here because as accountants we think, well, the primary place to do financial reporting is from the general ledger, so let's get as much information into that general ledger and chart of account structure as we possibly can, because then we'll be able to answer any question that comes to mind. Sometimes in doing that, we can make the GL structure too big, too wide, too detailed. So, you know, we want to be careful that we don't overburden the GL simply because our reporting tool of choice happens to be GL focused. In the case of, you know, Dynamics GP, we might say, well, we're going to build the most detailed general ledger because I'm in love with Management Reporter and it has all these great features in there. We also need to remember that sometimes information can come out of the subledgers through different reporting mechanisms, whether it's SQL reporting services or the report writer reports that are included within GP, or, for instance, a smart list. So a bit of a balancing act here between what really is available as information in the system and what pieces do we need in the GL. I put an example on here. We worked with a client a long time ago who had decided early on in the growth stages of their business to add a segment in their chart of accounts for salespeople. You can imagine that 8 or 10 years later, they were in technology, and 8 or 10 years later, they had over 100,000 general ledger accounts. And they said, you know, John, this is becoming a little bit slow. We feel like our chart of accounts is out of control. And when we pinpointed the reason, what we found was, well, we have a salesperson segment. And every time we hire a salesperson, we're using mass modify and just creating a long list of accounts. Once those accounts have transactions, unfortunately, they're part of the system, and we can't get rid of them. So, you know, we want to think about that. We want to make sure that we have the right segments in the right place, and that leads directly into the first thing we have to think about, which is the structure. Now, the great news about Dynamics GP and just how, you know, how feature-laden and functionally robust this ERP is that we've got multi-dimensional financial reporting capability here. And what that means is that when we think about our chart of accounts, we can think beyond just the chart of accounts segments. Certainly, the chart of accounts segment structure is the first thing we think about. In Dynamics GP, it will allow us to add up to 10. You know, we put the word yikes in there. I have worked with a client who had a 10-segment chart of accounts structure. It was painful. It was extremely painful to use. You can imagine if at the end of the month you had to enter a series of adjusting entries and you're typing in account strings with 10 segments. It was probably all between 30 and 40 characters long. I think to put just a simple debit and credit journal entry in the system, it would probably take me 3 or 4 minutes. Never mind just all the different ways to look things up and the permutations and combinations that were required to come up with an account list. Very, very big. The great thing about the system is that it allows us to think beyond the GL segments as well. We can look at account categories. We can look at user-defined fields on the GL account card. And we also have analytical accounting. So let's just think about this for a second. If we look at the main screens in Dynamics GP, we know we've got the maximum account length of 66 characters. We know we can put up to 10 possible segments in the structure. Okay, that's good. But when we think about that segment structure, we need to also think about the other areas we can track and we can use for reporting and aggregation. Let's think about segments as grouping mechanisms. So on the left side of the screen, we've got a way to group financial reports by division, account, and department if we use those 3 segments in the structure. However, in our reporting tools, we can also group and aggregate by the category. And that's on the right-hand side of the screen in the account card. And as you know, if you set up a new GL account in GP, it forces us to add a category. What you may not know is that you can change those category names and you can add new categories to the category list. So you can personalize your categories to your company. Of course, we're going to recommend that if you have a multi-entity company, multiple legal entities, that we categorize and use the same categories, if possible, in each of the companies, because it will help us with reporting. Another thing that's on this screen that is available in most of the reporting tools now is the ability to use the user-defined fields at the bottom, user-defined 1, 2, 3, and 4. And those can become yet another way of grouping information for financial reporting to serve it up to you to make it easier. Continuing along with this story, we now have analytical accounting in the tool set. And if you think about analytical accounting, it's giving us an ability to create as many financial tracking dimensions and financial reporting dimensions as we might desire. And it has a great place in this thought process, because what we'll see is that analytical accounting is also nicely available for reporting in the current GL-based report tool, Management Reporter. And if you take a look at this screen, it shows exactly what we're talking about in Management Reporter. We've opened up a row as if we're going to go create a new financial report, and you can see on the left-hand side of this screen, we've got our core chart of account segments, and in the second kind of block there in orange, what you're seeing is we've got other financial dimensions. We've got, the account category showing up. We've got user-defined field 1 from the account card showing up. We've got 2 analytical accounting dimensions, one called consulting revenue by employee and one called XYZ. Just to point out that it's not just the GL segments that we report on. We've got grouping and aggregation across these other financial dimensions. So if we're thinking about restructuring our chart of accounts, we need to think about these 2 sets and say, hey, maybe I don't need everything in the segment. Maybe I can put something in analytical accounting, or maybe that type of information is better suited to a category or a user-defined field, because it's all available here really easily to use in our reports that we generate. So we have a lot of different options. There's a lot of things out there to think about. Where do we start, and what do we, how do we get this thing going? What is the right structure, and what kind of decisions do we need to make to help us really build out the right GL for the organization? The first thing we'll say is, let's start by considering core chart of accounts segments versus analytical accounting, okay? Versus analytical accounting dimensions or segments. And the screen we just showed before shows you that they're, from a reporting perspective, they're treated with equal weight. So how do we determine what to put in a chart of accounts segment? And if we're thinking about analytical accounting, what would we put in analytical accounting? And then, when we have these discussions with clients, we inevitably end up in a discussion about, well, why wouldn't I put that in the chart of accounts? Or why wouldn't I put that in analytical accounting? And having gone through this, we've kind of grouped the reasons or the rationale here. Let's think about chart of accounts as follows. Let's think about our statutory financial reporting needs. Okay, so let's think about our P&L, our balance sheet, and our statement of cash flows. And let's agree that we need that hard-coded structure in the chart of accounts to provide us with all of our statutory financial reporting. Some management reporting in there is usually involved as well. From experience, we would say 5 segments in the chart of accounts is really a maximum. What we see out there the most is 3 or 4. Some of our clients have 2. Many of them have 5. I think personally, as soon as you get beyond 5 and 15 characters, you're getting into a very intense kind of chart of account structure that's pretty detailed. And every time I've looked at one, I've said to myself, that could be done through a category and we could drop that segment. That could be done through analytical accounting, we could drop that segment. So part of it is the more segments you add and the more characters you add, the more GL accounts you're going to have, the longer the list is. The longer the list is, the more difficult it is to manage, as everybody knows. So I really stick to 3 to 5 segments as an ideal number, but of course the system will allow you to go to as many as 10. It is your decision. This is just a suggestion. We also want to think about in our new structure that we allow enough characters or digits within each segment to allow for growth. So someone might say to me, well, we want to put a project in our GL account segment. And we'll say, okay, and they'll have reasons and rationale as to why. and we'll say, well, how many projects do you manage every year? How many new projects do you get? And they might say, well, John, we get 90 new projects a year. So they'll say, given that we might have to look at this again in 10 years, let's use a 3-segment. In that scenario, I'd say let's use 4. Let's use 4 digits in there in that particular project segment because I want to allow for growth. We don't know. Next year, maybe you'll get 180 new projects. And all of a sudden, if we were at a 3-digit segment, we might be tripping the maximum in 5 years, not 10. So let's just think about enough digits to allow for growth. And then the other big one. The big one for me is when I put this in here versus analytical accounting, when I put it in a chart of account segment, it's all about the short-term versus long-term nature of what you're tracking. So by that I mean in a chart of account segment, you're always going to have a dedicated segment for the natural, or some people refer to it the main account segment. It's always going to be there. We can't run the books without it. So guaranteed that's there. That's one of them. And then oftentimes we'll see things like department, division, business unit, sometimes to a lesser extent the product line or the project. But if you think about a natural, a division and department, or even a business unit, those kind of things are going to stick. As long as the organization is alive, we are going to have to report on those. We know we're going to have to report on those. We know we need that breakdown. It's not going away. They'll always, those kind of segments and tracking will always be part of the org structure. So it makes sense to have that as a main segment in the chart of accounts. When we look at analytical accounting dimensions, we really think about management reporting internally, and we think about tracking things in analytical accounting that may be short-term in nature or subject to change, because analytical accounting lends itself really well to that. For instance, in analytical accounting, I often use this one with demos we do, is to say, hey, we've got a 3-segment GL structure, and the controller has said that any time a debit hits employee expenses, they want the name of the employee attached to the transaction. And what a great way to use analytical accounting, because I don't want to create a segment in my chart of accounts to track employees and then have to set up 200 accounts for every employee, and if somebody leaves, be stuck with that in the structure. I don't want that. Analytical accounting is the perfect answer for that. Analytical accounting would allow us to set up an employee, would allow us to tag it to a transaction. If the employee leaves, hey, we just inactivate the employee. We haven't overburdened the GL. We haven't created hundreds of GL accounts specific for that employee. Another thing, short-term in nature. Sometimes you see analytical accounting used in the marketing world. People will say, well, I want to track costs against a trade show. Well, we might do that trade show once, and after we do the trade show, we're never going to do it again. So again, there I'm saying, well, I don't want to create a trade show set of GL accounts for a specific 2013 trade show and have to look at that GL account list for the next 6 years if we never go back to the show. Analytical accounting, again, is the perfect answer in that scenario. So short-term in nature, management reporting enabled. But remember, back in Management Reporter, we're treating the chart of account segments and analytical accounting dimensions with equal weight. So, from a reporting perspective, they're perfectly equal. From a long-term structure perspective, there's some key differences. The next thing we want to think about is logical sequence and ordering. And this, to accountants, this might seem like, hey, this is accounting 101. I'm always surprised how much variation we see in this when we do GL restructures. And I'm not saying you have to follow this exactly, but what I'm saying is there needs to be a logic built into the numbering. The typical one we see used, and the one we advise on, is something like what's up here, where 1,000s are assets, 2,000s liability, 3,000s equity, 4,000s revenue, and then cost of goods sold if expenses fall from 5,000 to 9,000 in some sort of logical manner. That helps everybody. It's also good to say that's a great way to understand how we should structure the chart of accounts in all of our legal entities, so that we know assets are always the 1,000 series or revenue is always the 4,000 series. It doesn't matter what specific company we're looking at. So really, really important to think about a logical pattern that can be applied to all of the companies. Then next we think about grouping within the segments. So we'll say, well, okay, if we have a segment dedicated to division, let's think about 100 being G&A, 200 being sales and marketing, and 300 being R&D. Because when we do our P&L for statutory financial reporting, that's how we group stuff. We just show expenses as G&A, sales and marketing, R&D. We might think about embedding departments within divisions. Instead of creating another segment for departments, let's interpret one segment as meaning two things. So I could have a segment dedicated to division/department, and I could know that the 100 series is G&A, and if I look at 100, it actually means finance, 110 means HR, 120 means IT, and they group together as 100s into G&A. Or we think about 200, 210, and 220. We put the examples of field sales, inside sales, and marketing, grouping up to sales and marketing. So again, we want to think about kind of, does this segment have to be dedicated to one thing, or can it cover actually two different financial reporting perspectives? And then it gets to the ideal scenario where you say, okay, given what you've just said, I've got a really clear picture of what I want to do. I understand what I have today. I understand where I want to go tomorrow. I've mapped this out in Excel. I want to get rid of a whole list of accounts. I want to merge them together. I want to restructure. I either want to increase the number of segments or decrease them. And I think I might have an opportunity to, maybe track one or two things in analytical accounting that, maybe we were tracking before as part of our, core chart of account structure. So how do I get to this perfect vision of what I want to have for the ultimate GL? And the answer here is we can help with this, and we have been helping the entire GP channel with this for a long, long time with our chart of accounts restructuring tool set. And there's really three pieces here that may be involved in this. The first one that you may or may not need to use is Reformatter. What Reformatter does is allows us to extend or change the number of segments in the GL structure if the account maximum has already been set. So on implementation, if we've gone in and said, hey, you've got a maximum account length of 12 characters, then I can't really go to this 5-segment structure with 3 characters each because I don't have room. Reformatter is going to allow us to do that. It's going to allow us to restructure and basically, kind of pave right over, drive right over that account maximum that was set earlier a long time ago, and kind of set it up exactly how you want. So if the new structure exceeds the maximum on that account segment setup card, then we need Reformatter. The second one that we need it everywhere usually when we do this is Changer. And Changer allows us to do a few things. First, what it allows us to do specifically with the general ledger, it allows us to renumber GL accounts, which means we can sequence them in the 1000s, 2000s, 3000s that we laid out on the page a little while ago. But at the same time, it also allows us to merge accounts together. And so what we end up, to make it really easy to use, what we end up doing is just running a smart list of, hey, here's the GL structure today in column A. In column B, tell us what the new equivalent account is. And then we import that into Changer. And it runs a process to effectively change the GL, the chart of accounts, to your desired structure. And it changes all of the history in the system as well. So with that tool, it's the key tool for restructuring the general ledger chart of accounts, and we can do it with Changer. And it's fairly easy to do. It is very robust. It works quick, and we have thousands and thousands of clients that have used it and partners that have used it to do exactly this. The third piece, which is new, is analytical accounting, new to GP, and we've got a couple of tools here to help as well. Sometimes we've shown analytical accounting to a client that's been with us for a long time and they said, hey, I wish I'd known about that when we had GP version 2. If it had been there in GP version 2, I might have made some different decisions about what I track in the chart of account segment structure because I could have used this. So in analytical accounting, we realized there was a need here, a need to say, I might be tracking something today in my chart of account structure, and really, I'd rather track it in analytical accounting. We've got something here called Segment Converter, And what segment converter does is it essentially moves, or copies is a better word, it copies the transaction history associated with a chart of accounts segment to transaction history associated with an analytical accounting segment. So if we think about an example, maybe I had a project segment in my chart of accounts, and I've got all kinds of transactions posted against it throughout history. If I go create an analytical accounting dimension called project and use segment converter, I can essentially copy all of that transaction history to analytical accounting. Then when I go back to Changer, I could wipe out the project segment in the GL chart of account structure, and I'd still have all my history because it would be under the analytical accounting segment. And that's something that we can accomplish with one of our analytical accounting tools called Segment Converter. We also know that if customers get heavily invested in analytical accounting, the time will come when they need to change analytical accounting codes and merge them together. And we have an analytical accounting changer as part of the analytical accounting tool set to help with that. Basically to merge, consolidate, renumber analytical accounting dimensions that you may be tracking. So these three pieces really help us get to the perfect kind of ultimate GL structure. And that's how it comes together to work. Let's just take a second here just to check if there are any questions out there, and we'll address those. Somebody's asking, are you seeing a lot of analytical accounting conversions? We still, to answer that question, we still see a tendency to think about tracking segments in the GL. I think there's a comfort level for a lot of existing customers with putting stuff in the general ledger chart of account structure. Certainly the newer customers are embracing analytical accounting and moving stuff to it. So yes, we are seeing that for sure. For sure, we are seeing some conversions to analytical accounting. There's a question there about Changer. Is there a maximum number of accounts you can change in one setting? So the answer to that question is there isn't really a system-imposed maximum on the number of changes we can make. However, we always recommend doing them if it's a huge list of accounts. What we do is we break it down into batches and just run it in batches. Just to make sure that everything's working correctly. Of course, with anything we do with a GL restructure, we're always going to do it in a test environment first and show you the before and after picture, and to make sure the trial balances tie out and that there's no risk around anything from a financial reporting perspective. So we will always go through tests, and usually when we go through the test process, we determine whether we need to break up a change process into a number of batches or whether we can just go in and do it all in one. I've personally done changes in one batch before. I've merged 24,000 general ledger accounts together. It was for a hospital out in Florida probably 9 or 10 years ago, right when I started with CRGroup. And certainly the tool handled that admirably with no issue at all and worked perfectly. It was 24,000 GL accounts into one, and that one comes to mind. And we've done some big GL restructures in the last few years with some larger clients, and the tool always performs very well, and it's well followed within the channel. There's a question out there saying, can you use these tools to recode historical expenses by, say, vendor versus their previous coding? Historical expenses by vendor, the Changer product will allow you to change vendor codes. If we're talking about, hey, this was tagged to CRGroup as the vendor when we purchased this item 4 years ago, and now I want it against somebody else, we actually would suggest that maybe we use analytical accounting to track that, and we can do a backfill process to those transactions to say, hey, anything with this particular vendor should be associated with an analytical accounting transaction called X, an analytical accounting tracking dimension, and we can use that as an opportunity to recode that. Okay, so if there are no other questions out there, I don't see any more popping up today, we will say thank you very much for attending this today, and thank you for your time. I certainly would encourage you to take a look at our website, and it's listed there for you, and you can learn more about the products and solutions that are available. And any of these products can be downloaded for trial against the Fabricam company for those of you who are interested in it. I know there are partners on the call, and we can certainly get you an NFR copy for that. And my contact information is listed there. If you have any specific questions that you'd like to address with me individually, please feel free to send me an email or reach out, and I'll be happy to get back to you.